When it comes to implementing risk management practices, there are a number of models which are adopted by institutions. One of these models is 3 lines of defense model. This model is implemented and adopted by most of the organizations, most particularly financial institutions. This model is recommended by Institute of Internal Auditor first in 2013 and it was revised in 2020. In this video, we'll talk about 2 aspects of 3 lines of defense model. First, we'll talk about the theoretical foundation of 3 lines of defense model, and then we will discuss the practical implementation aspect of 3 lines of defense model, and how do we actually do it in the real world. Hello everyone, my name is Uwais Atta. I am a risk professional with more than 15 years of experience with clients in more than 17 countries. So let's dive in. Bismillah. So when it comes to risk management, we know that risk is everywhere, and the worst part of risk is we cannot just avoid it. We can only mitigate it. We can only manage it. We cannot reduce or eliminate the risk altogether. Now, when we have to manage a risk at an organizational level, one of the governance aspect of it is to build organization in a way that the risk is managed at certain levels, at different levels. And when we talk about implementation or management of risk at a certain level, 3 lines of defense model is introduced. Now the idea here is that we have first line of defense, second line of defense, and third line of defense, and separate level of risk are derived or managed at different line of risk. So for example, the first line of defense is your management controls. So first line of defense are the people who are going in the market, the risk managers, the relationship managers, the customer representatives, the surveyors, all of the people who are going into the market, into the front line where they are directly interacting with the client. So risk relationship manager is actually involved in filling all the data for the customer that you will be giving loan to. And what happens is that when they are on the ground, when they're dealing with the client, there are certain aspects that they have to identify. Okay, so they have to fill a certain questionnaire, a certain list of questions. They have to acquire certain data requirements from the customer, and with their experience, they may identify certain risks that this particular customer is not a good fit for the organization. But it can only happen if you train them well, if they know, if they are aware of the risk related responsibilities that they have, and they are just concerned about the business and not considering the risk that they are building on our book. Then we have the second line of defense. So we are trying to stop all the risk at first line of defense, identify any irregularities, identify any differentiation, any risk that they may identify. But if we miss that risk in the first line of defense, we have the second line of defense. It includes like financial control, the security, the risk management, the compliance, quality, inspection. So for example, risk management and compliance are 2 critical pillars of second line of defense. So the first line of defense and second line of defense are involved during the process. So for example, when we are giving a loan to a particular company, the first line of defense will fill all sort of that data that we have, and the compliance and risk management will ensure that all of the limits are being monitored. There aren't any sections on that particular corporate, on that particular company. The regulatory limits are fine, the internal limits are fine. All of these things are considered before we give approval, before we actually give lending to that particular institution. So both first line and second line of defense are involved in the process, but first line of defense is more towards the phase of the organization. They are involved on the ground. And when it comes to risk management and compliance and IT and other support function, they are more about towards the documentation. So first line of defense does its work. Now when it comes to scrutinizing it, when it comes to more critical aspect of it from a regulatory perspective, from an internal limit perspective, that's where the second line of defense comes in. Now let's say that first line of defense did not do the job well, the second line of defense missed it, then comes the third line of defense, the internal audit. Now internal audit is on a post facto basis. So basically you have given the loan to that particular organization, Now, internal audit will come after 3 months, and it will analyze on a sample basis all sort of loans that we have given to organizations. And for example, they identify that there was a limit breach in one of the clients that we have. So they identify it, and the idea is that internal audit is independent of the first line and second line of defense. They do independent evaluation of whatever work the first line of and second line of defense is doing, and that is why they directly report to the board audit committee and don't report to the CEO. So first line of defense, the front runner, the people who are engaged with the clients, with the customers, they have to identify and manage the risk at first line, and don't let risk and compliance be a second line of defense do it. But if they miss it, or if there any chance that they cannot identify it, then the second line of defense is there, and they have to make sure that no risk is left unmanaged. If it's missed there as well, we have a third line of defense, which is on a post facto basis, where internal audit performs all its tasks. Now, all of this third line of defense is further strengthened by the presence of external audit and regulator. They are the enforcer. They are the people who actually further enhance or further enforce this three lines of defense model. So first line of defense is your businesses, second line of defense is risk, compliance, IT, support functions, and the third line of defense is internal audit. So this is what theoretical aspect that we have. Now let's talk about its implementation aspect. How do we actually implement three lines of defense model in an organization? So the first thing that we have to do is to establish a structure and roles. So we have to clearly define the responsibilities for each line. So first line of defense, second line of defense, and third line of defense, what do they have to do? For example, there is a separate checklist that every first line of defense has to fill, and there are certain requirements. For example, they have to fill a scorecard for the customer, and that scorecard is used by the second line of defense to identify whether they meet the rating criteria of the internal organization or not. So we have to very clearly identify the responsibilities of each line of defense. Then we have to map function into first, second, and third line of defense. So in the earlier slide, I have told you that businesses are first line, risk and compliance second line, and internal audit is third line. Now, internal audit third line, it's given, but there are certain overlapping between first line and second line of defense. For example, credit is considered to first line of defense in some places and second line of defense in some places. So there's some discrepancy. There is some implementation aspect of these. But as an organization, you know your risk, you know your protocols, you know your risk management structure. So as an organization, you have to specifically define what sort of department you have in the first line of defense and the second line of defense. And once you do that, you have to report it and record it in a specific risk governance framework. So for example, usually risk management framework is the one where we have this three lines of defense model discussion, but you may have some governance document at a board level, at a management level, where you identify that you as an organization is following a three lines of defense model, and in the end it has to be approved, it has to be managed, it has to be vetted by the senior management and board. Remember, when it comes to risk management, everything comes from the board. The board is the ultimate responsible for any risk management activities. So either the entire board do it, or they do it via board risk committee. So every bank has a board risk committee as well. So whatever the structure of that organization is, either via full board or either via BRC, but it has to be vetted, it has to be approved by the board risk committee or board, the ultimate ownership of this risk. Then once you do that, we have to enable ownership and collaboration. So as I mentioned earlier, we have to train first line, second line, and third line about their responsibilities. So as I said earlier, first line of defense is always focused on business. They are not concerned about risk. They are not that much concerned about risk. So we have to train them. We have to, for example, train them about the scorecard that they are filling, and we have to let them realize that, you know, these 5 fields that you are leaving blank, it's of utmost criticality, and we cannot actually realize the actual risk of that particular customer if we are not filling it. What they do is that they don't get that sort of data, they just leave it blank or insert 0 lines there just to meet the requirement. So training the first line of defense is very critical. Then second line of defense, the risk and compliance and IT and other services, we have to train them as well. Of course, they are more aware about the risk because risk management is risk at the end of the day. So they are more aware about the risk management practices. And then we have to train the third line of defense as well as to what sort of responsibilities you have. One critical aspect for internal audit is that it has to be independent and it has to be well resourced. So we should have right kind of talent when it comes to internal audit. And in the end, we have to set up regular interaction between the lines. So there should be discussion on the forums, on the committees. It should have follow-ups, and we should be considering it on a regular basis. Then we have to, in the final step, we have to integrate, monitor, and evolve. So we have to embed risk processes, these risk management practices into the system. For example, RCSA, the risk control self-assessment or key risk indicator or incident reporting or internal reporting via either risk appetite statements, it should all be embedded in each and every process that we have. Now, see, when it comes to risk management, it's an evolving field. It's an evolving area. So the risk that is relevant today may not be relevant tomorrow, or tomorrow we may have new phase which is faced by the organizations. So what we need to do is we have to be vigilant, we have to proactive, we have to make ourselves remain relevant about the risk structure and the risk dynamics that we have. So to do that, we have to keep evolving, we have to keep monitoring, we have to keep changing the risk governance practices that we have. And again, we have to review performance and we have to adopt based on audits, lesson learned, and regulatory shifts. So for example, internal audit on the third line of defense identify some key areas. Now when these areas of improvement are identified, it should be rectified on a timely basis, and then it should be communicated to all over the organization. So if one department was doing some mistake, there are possibilities that another department would be doing similar sort of mistake when it comes to, for example, the first line of defense. So what we need to do is keep the lessons, learn from it, and then be dynamic enough to implement those changes. And that is how we can keep relevant, we can manage our risk in a better way. So this is what we had from this 3 lines of defense. I hope you liked it. If you have any comment, any feedback, please feel free to write in the comment section. See you in the next video. Massalam.